Look, I'm about to tell you something that will make you uncomfortable. If you're over 35 and you haven't made these 5 changes to your portfolio, you will lose money in the next crash. Not might. Will. Not because I can predict when the crash comes. I can't. But because I can predict human behavior. And I know exactly what most people over 35 are doing right now that guarantees they'll panic sell at the bottom when volatility hits. The portfolio manager who called the 2008 crash perfectly, he still lost everything. The tech executive with $2.3 million in 2021, he's down to $1.1 million today. The Chicago couple who used leverage to get rich in real estate, they lost $80,000 in 2 years. They weren't wrong about the market. They were wrong about themselves. And in the next crash, the same psychological traps will destroy another generation of investors who think they're prepared but aren't. If you're ready to learn the 5 rules that separate survivors from casualties, hit that like button right now. Because what I'm about to show you isn't about predicting the next crash. It's about making the next crash irrelevant. Before we get into this, do me a favor, drop a comment and tell me where you're watching from. I want to know who's here, city, state, country. Just let me know. Here's what really happened to these people, and pay attention, because this is probably your future if you don't change. The portfolio manager was 42 years old in late 2007. Smart, educated, worked at a major firm in New York. He looked at the data. Housing prices were falling, credit was tightening, the signs were obvious. He told everyone, "We're heading into a recession. I'm getting defensive." He moved 70% of his clients' portfolios into cash and bonds in November 2007. He was protecting them. He was smart. He knew what was coming. Then the market rallied. November, December, January. The S&P 500 went up 7%. His clients called him. "Why are we in cash? We're missing the rally." He felt stupid. The pressure mounted. In February 2008, he capitulated. He moved everything back into stocks. Maybe I was wrong. Maybe the economy will be fine. March 2008, Bear Stearns collapsed. September 2008, Lehman Brothers failed. The market crashed 50% over the next 6 months. His clients lost everything. Not because he was wrong about the recession. He was right. But because he thought he could time it perfectly. He needed to know exactly when it would happen. And that need for certainty destroyed him. The tech executive? He was 48 years old in 2021, senior position at a major company in San Francisco. His net worth was $2.3 million, sounds successful. But 78% of his wealth was in one sector, technology. $1.8 million in company stock options. $300,000 in his house. $200,000 in his 401k, mostly in tech funds. He knew this was risky. People told him to diversify, but the stock had gone up 300% in 5 years. Selling felt like giving up free money. He told himself, "I'll diversify after it goes up another 50%. Just one more year." Then came 2022. Interest rates rose. Tech stocks crashed. His company stock dropped 65%. His 401k dropped 40%. In 18 months, his net worth went from $2.3 million to $1.1 million. He lost $1.2 million, is more than half his wealth. Now he's 50 years old and has to work 5 more years, maybe 10. The Chicago couple? He was 52. She was 49 in 2019. They had $800,000 in retirement accounts. Good savers, but they wanted more. They took out a $400,000 home equity line of credit against their paid-off house, bought 2 rental properties, leveraged up. For 2 years, it worked. Then 2021 hit. Their tenants stopped paying. Eviction moratoriums prevented them from removing non-paying tenants. The HELOC payments came due every month. $3,000 out of pocket. 6 months, 9 months, 12 months. They burned through $40,000 in savings trying to stay afloat. They tried to sell. The market had softened. No buyers. They dropped the price. Finally sold at a loss. After commissions and closing costs, they netted $370,000. They still owed $400,000 on the HELOC. They had to pull $30,000 from their retirement accounts to pay off the debt, plus penalties, plus taxes. Total damage, $80,000 in cash losses, $30,000 from retirement accounts. 2 years of stress, all because they used leverage. These are not stupid people. They are people like you, successful, educated. They thought they were prepared. They were not. And the next crash will create thousands more just like them. Unless you follow 5 specific rules. Rules that anyone can follow, but most won't, because they require giving up the illusion of control. The first rule is the hardest. Let's start. Dorm Rule 1. Accept that you don't know what's coming. Most people think they know what's coming. They read headlines, they follow analysts, they watch CNBC, they form opinions about inflation, interest rates, GDP growth, and they position their portfolios based on these opinions. This is catastrophic thinking. Here's the truth. You don't know what will happen next year. Neither do I. Neither does anyone. The Federal Reserve doesn't know. Wall Street doesn't know. The smartest economists in the world don't know. And if you're making financial decisions based on knowing what's coming, you're gambling, not investing. The problem is that admitting ignorance feels like weakness. People want to feel informed, in control, ahead of the curve. So they consume information constantly. They read predictions. They follow trends. They convince themselves they know something, and this false confidence destroys them. That portfolio manager in 2007, he was right about the recession, but he was wrong about when. And that timing mistake destroyed everything. If he had accepted that he didn't know when the crash would come, he would have stayed defensive. He would have missed some upside, but he would have survived the crash. Instead, he tried to know the unknowable, and his clients paid the price. Let me show you the trap. Say you're 90% sure the market will crash soon. You sell everything and go to cash. If you're right, you save yourself a 30% loss. Brilliant! But what if you're wrong? What if the market is flat? You miss 8% in dividends and growth. What if it rallies 20%? You miss everything and feel like an idiot. Your certainty locked you into one outcome. Now say you accept that you don't know. You hold a diversified portfolio. You have stocks for growth if things go well. You have bonds for safety if things go badly. You have cash for opportunities if things crash. You're positioned for multiple outcomes. You won't maximize returns in any single scenario, but you'll survive all scenarios, and survival is what matters when you're over 35. Most people can't do this. They think accepting ignorance means doing nothing. It doesn't. It means positioning for multiple futures, not betting on one. Warren and I have never based a decision on a macroeconomic forecast. Never. Not once in 60 years. We don't know what interest rates will do. We don't know what inflation will do. We don't know what GDP will do. And we don't care. We position Berkshire to survive all environments. That's why we're still here after 6 decades. That's why we've compounded through 10 recessions, multiple wars, stagflation, financial crises, and pandemics. Think about this right now. How much of your portfolio depends on being right about what happens next? If inflation stays low, if rates don't rise, if the economy stays strong, if your company keeps growing, if more than half your portfolio depends on one of those things being true, you're not diversified. You're concentrated in a prediction. And when that prediction fails, and eventually it will, you'll panic. Here's what you need to understand. The moment you think you know what's coming, you've already lost, because knowing requires certainty. And certainty doesn't exist in markets. What exists is probability. What exists is preparation. What exists is positioning yourself so that multiple outcomes work in your favor. The investors who survived 2008 weren't the ones who predicted it. Plenty of people predicted 2008 and still lost money because they tried to time it. The survivors were the ones who said, "I don't know when the crash comes, but I'm prepared whenever it does." They had diversified portfolios. They had cash. They had no leverage. They had plans. And when the crash came, they didn't panic. They executed, except that you don't know what's coming. Position accordingly. But accepting ignorance isn't enough if you're making the next fatal mistake. Rule 2. Reduce your concentration risk. Most people over 35 have too much of their wealth in too few places: their house, their company stock, their 401k and 3 funds, maybe crypto, maybe a rental property. They think they're diversified. They're not. They're concentrated. And concentration is dangerous when you're over 35 because you don't have time to recover from catastrophic losses. Here's why this matters more than you think. When you're 25, concentration is acceptable. You have 40 years to recover if you're wrong. A 50% loss at 25 becomes a learning experience. A 50% loss at 50 becomes a retirement crisis. The math changes as you age, and most people don't adjust. The second problem is that concentration creates emotional vulnerability. If 60% of your net worth is in your house, you can't think clearly about housing markets. Every negative headline terrifies you. Every downturn feels personal. You make emotional decisions to protect what you can't afford to lose. And those emotional decisions destroy wealth. The third problem is that concentration amplifies sequence of returns risk. This is the danger that a market crash happens right when you need the money. If all your wealth is in stocks and the market crashes the year you retire, you're finished. You have no buffer, no alternatives. You're forced to sell at the bottom just to live. And forced selling at the bottom is how retirements get destroyed. That tech executive, he wasn't wrong about technology. Technology is fine. He was wrong about concentration. 78% of his wealth in one sector. When that sector crashed, he had no protection. He lost $1.2 million in 18 months because he was concentrated instead of diversified. Here's the simple math. If you have $1 million and it's 100% in stocks, a 40% crash leaves you with $600,000. If you have $1 million split 60% stocks, 30% bonds, 10% cash, that same crash leaves you with $760,000. You lose less. You panic less. You survive. That $160,000 difference is the cost of concentration. But most people don't diversify because they think it limits upside. They're right. It does. If stocks rally 50%, the 100% stock portfolio makes $500,000. The diversified portfolio makes $300,000. Less upside, less excitement, less bragging rights. But here's what they miss. The 100% stock portfolio also has 100% downside risk. One bad sequence and you're destroyed. The diversified portfolio has limited downside. You survive the crashes. You stay in the game. And staying in the game for 30 years beats maximizing gains for 5 years and then getting wiped out. Compounding requires survival, and survival requires diversification. Warren says, diversification is protection against ignorance, and we're all ignorant about what's coming next. So diversify. I'm not talking about owning 50 stocks instead of 10. That's not diversification. That's collection. I'm talking about true diversification. Different asset classes, different geographies, different time horizons, different risk profiles. Stocks, bonds, real estate, commodities, cash. U.S., international, emerging markets. Growth, value, income. Public, private, liquid, illiquid. When the next crash comes, you want multiple parts of your portfolio working, not everything in one basket, hoping that basket does. Well, check your portfolio right now. What percentage is your biggest position? If it's more than 20%, you're concentrated. Now add up everything tied to one sector: your job, your company's stock, your real estate, your side investments. If they're all tied to the same industry or the same economic outcome, you're not diversified. You're making one big bet. And if that bet fails, everything fails at once. Reduce your concentration risk. But diversification alone won't save you if you're making the next deadly mistake. Now here's where people really destroy themselves. They accept they don't know what's coming. Good. They diversify across assets. Smart. But then they amplify everything with leverage, and leverage is the only way a smart person can go broke. Rule 3. Cut your leverage now. Leverage is the only way a smart person can go broke, and in the next crash, leverage will destroy more wealth than the crash itself. Because leverage doesn't care if you're right in the long run. It only cares about short-term performance. And when things move against you, leverage forces you to act at the worst possible moment. Here's the truth. If you have debt beyond your mortgage, margin debt, home equity lines of credit, personal loans, credit card balances, you're not positioned to survive the next crash. You're one shock away from forced liquidation, one job loss, one market correction, one unexpected expense, and leverage turns manageable problems into catastrophic ones. The problem is that leverage feels safe when things are going well. You borrow against your home at 4% to invest in stocks, returning 10%. You feel smart. You're making 6% on borrowed money, free money, until the stocks drop 20% and suddenly you owe more than your investments are worth. Now you're forced to sell at the bottom just to meet the margin call, and forced selling is how smart people go broke. The second problem is that leverage creates psychological pressure that corrupts your judgment. When you have debt, you can't think clearly. Every market downturn feels like an emergency. Every correction threatens your survival. You make emotional decisions to protect yourself, and those emotional decisions destroy wealth. The leverage doesn't just amplify your returns, it amplifies your fear, and fear makes you sell at exactly the wrong time. The third problem is that leverage in your 40s and 50s is different than leverage in your 20s. A young person can recover from a leverage blow-up. They have time. They have earning power. They can start over. A 50-year-old can't. A leverage loss at 50 becomes a permanent reduction in your retirement. There's no coming back. Your compounding years are over. You're just trying to survive to the finish line. That Chicago couple? They weren't wrong about real estate. Real estate is fine. They were wrong about leverage. They used a $400,000 HELOC to amplify their bets. And when their tenant stopped paying, the leverage turned a manageable problem into a catastrophe. They lost $80,000 and 2 years of their lives to stress, all because they borrowed money they couldn't afford to lose. Let me show you the math that proves this. If you have $500,000 in stocks with no debt, a 30% crash leaves you with $350,000, painful but survivable. You hold, you wait, it recovers, you're fine. If you have $500,000 in stocks bought with $200,000 of margin debt, a 30% crash leaves you with $350,000 in stocks and $200,000 in debt. Net worth, $150,000. Your broker calls. You need to pay down the margin or we sell your stocks. You don't have the cash. They force you to sell at $350,000. You pay back the $200,000 debt. You're left with $150,000. You lost 70% while the market only dropped 30%. That's what leverage does. It turns a survivable crash into a permanent catastrophe. Warren and I have never used leverage, never borrowed money to invest, never used margin, never took out loans to amplify returns, and that's why we survived every crash for 60 years. We were never forced to sell. We were never at the mercy of a lender. We could sit through downturns and wait for recoveries. That's the edge. Not intelligence, not timing, just the absence of leverage. How much debt do you have right now outside your mortgage? Margin, HELOC, credit cards, personal loans? Add it up. If that number is more than 10% of your net worth, you're not investing, you're gambling. And the next crash will call your bluff. Cut your leverage now. Pay off the margin. Pay off the HELOCs. Pay down the credit cards. Get to a place where you owe nothing except maybe your mortgage. That's how you position yourself to survive the next crash. But even without leverage, you'll fail if you don't have the next critical element. Rule 4. Build a cash buffer. Most people over 35 have no cash. Everything is invested. Stocks, real estate, retirement accounts. They think this is smart. They think cash is trash. They think sitting in cash is wasting opportunity. They're wrong, and in the next crash, lack of cash will force them to sell assets at the worst possible time. Here's the truth. Cash is not an investment. Cash is insurance. It's protection against forced liquidation. It's what keeps you from having to sell stocks at the bottom because you need to pay bills. It's what lets you buy opportunities when everyone else is panicking. And in the next crash, cash will be the difference between surviving and failing. The problem is that people hate holding cash. They see it earning 4% or 5% in the money market while stocks are up 20%. They feel stupid. They feel like they're missing out. So they invest every dollar. And when the emergency comes, and it always comes, they have no buffer. They're forced to sell at the worst time. The second problem is that people underestimate how much cash they need. They think 1 month of expenses is enough. Maybe 3 months. That's not enough. If you're over 35, you need at least 6 months of living. Expenses in cash, 12 months is better. 24 months is ideal. Because when things go wrong, they don't resolve quickly. Let me tell you about a software engineer in Seattle. This was 2020. He was 44 years old, made $180,000 a year, had $600,000 in his 401k, all invested in index funds. He had $12,000 in his checking account. That was it. No emergency fund, no cash reserves. Everything was invested because he didn't want to miss gains. March 2020, COVID hit. His company did layoffs. He was gone. Overnight, no income. He had bills. Mortgage, $3,500. Car payment, $600. Insurance, $400. Utilities, food, everything else, $2,000. Total monthly burn, $6,500. He had $12,000 in cash. That covered 2 months. What about month 3? He applied for unemployment. It took 6 weeks to arrive. He applied for jobs. Nothing came through. Month 3, he had to start selling his 401k. The market was down 30%. He sold $20,000 worth of investments at the bottom to cover expenses. Then month 4, another $20,000. Month 5, another $20,000. 6 months later, he found a new job. But he had sold $60,000 from his 401k at a 30% loss. If he had held, that $60,000 would have recovered to $80,000 within a year. Instead, he locked in the loss permanently. all because he had no cash buffer. By 2024, the market had fully recovered, but his 401k was still down $60,000 from where it should have been. He lost years of compounding, not because he was wrong about stocks, because he had no cash when he needed it. Here's the arithmetic. If you have $500,000 in stocks and $0 in cash, and you lose your job, you must sell stocks to leave. If the market is down 30%, you sell at a loss. If you have $400,000 in stocks and $100,000 in cash, and you lose your job, you live off the cash. The stocks recover. You preserve wealth. The opportunity cost of holding cash is real. If stocks go up 20% and you hold 20% in cash, you miss 4% of gains. But the cost of not having cash when you need it is permanent. You sell at the bottom, you lock in losses, you destroy compounding. That's far worse than missing 4% in a good year. Warren keeps $100 billion in cash at Berkshire. People mock him for it. You're wasting opportunity. But that cash is what lets him buy when everyone else is selling. In 2008, when the financial system was collapsing, Warren deployed $20 billion. Goldman Sachs, Bank of America. He got incredible deals because he had cash when no one else did. Cash gives you options. Cash gives you time. Cash gives you the ability to be rational when everyone else is emotional. And in the next crash, rationality will be rare. Open your bank account right now. How many months of expenses do you have in cash? 1 month? 3 months? 0? If it's less than 6 months, you're one emergency away from selling your stocks at the worst possible time. That's not a strategy. That's a catastrophe waiting to happen. Build a cash buffer. 6 months minimum. 12 months better. And don't touch it unless there's a true emergency. That buffer is what keeps you from panic selling when the next crash brings volatility. But even with cash and no leverage, you'll fail if you make the final deadly mistake. Here's the cruel truth. You could do everything right, except you don't know. Diversify properly, cut all leverage, build a massive cash buffer, and you'll still lose money in the next crash. Why? Because when the moment comes, you'll panic. You'll abandon your plan. You'll sell at the bottom, and you'll destroy everything you built. Rule 5. Decide now what you'll do. The biggest mistake people make in market downturns is making decisions in real time. The market crashes. They panic. They check their accounts every day. They watch CNBC. They see red numbers. They feel pain. And they make emotional decisions. They sell. They change their strategy. They abandon their plan. And they destroy wealth. Here's the truth. You can't think clearly when you're in pain. When your account is down 30%, you're not rational. You're emotional. Fear takes over. And fear makes you do stupid things. The only way to avoid this is to decide now, when you're calm, what you'll do when the next crash comes. Not during the crash. Now. Write it down. Make a plan. If the market drops 20%, I will do nothing. If it drops 30%, I will buy more. If it drops 50%, I'll deploy my cash reserves. Whatever your plan is, decide now. Because in the moment, you won't be able to think. The problem is that most people don't have a plan. They think they'll figure it out when it happens. They think they'll stay rational. They won't. Nobody does. I've watched this for 70 years. Smart people, successful people, people who know better. They all panic when the market crashes because pain overrides logic. The second problem is that without a plan, you default to the crowd. When everyone is selling, you sell. When everyone is panicking, you panic. And the crowd is always wrong at the extremes. The crowd sells at the bottom and buys at the top. And if you follow the crowd, You get the crowd's results, permanent losses. Let me tell you about two investors in 2008. Both were 55 years old. Both had $800,000 in their 401ks. Both retired at the end of 2007. Both planned to live off their portfolios. Investor A had no plan. When the market crashed in 2008, he watched his account drop from $800,000 to $600,000. He felt sick. He couldn't sleep. He checked his balance every day. It kept dropping. $550,000, $500,000, $450,000. In March 2009, when the market hit bottom, his account was at $400,000. He panicked. I can't lose any more. I have to protect what's left. He sold everything, moved to cash, locked in the loss. The market recovered. By 2010, it was back to even. By 2013, it had doubled from the bottom. Investor A missed all of it. He stayed in cash, terrified. By 2024, his $400,000 had grown to $480,000 in a money market. He was living off it carefully, hoping it would last. Investor B had a plan. Before he retired, he decided, if the market crashes, I will not sell. I will live off my cash reserves and let the portfolio recover. I have 24 months of expenses in cash. That's my buffer. When the crash came, his account dropped the same way, $800,000 to $400,000. But he didn't sell. He lived off his cash. He didn't check his account. He followed his plan. By 2013, his portfolio had recovered to $900,000. By 2024, it had grown to $1.8 million. He lived comfortably. He never ran out of money. He even left money to his kids. Same starting point, same crash, different plan. One ended with $480,000 and constant anxiety. The other ended with $1.8 million in financial security. The difference wasn't intelligence. It was having a plan and following it. Here's the arithmetic that changes everything. If you sell at the bottom, you lock in permanent losses. An $800,000 portfolio that drops to $400,000 and you sell, you have $400,000 forever. If you hold and let it recover, $400,000 grows back to $800,000 in a few years, then compounds from there. The recovery is predictable. The pain is temporary, but you can't see this when you're in the middle of it. That's why you decide now. Take out a piece of paper, write down your plan. In the next crash, if the market drops 20%, I will do nothing. If it drops 30%, I will do nothing. If it drops 40%, I will deploy half my cash reserves and buy index funds. If it drops 50%, I will deploy the rest. Be specific. Be clear. Whatever your plan is, write it down. And when the moment comes, don't think. Don't analyze. Don't watch CNBC. Don't check your account daily. Just follow the plan. That's how you survive the next crash. Not by predicting it, by preparing for it. I learned this from watching failure. I watched long-term capital management blow up with leverage. I watched the dot-com bubble destroy people who concentrated in tech. I watched 2008 wipe out people who had no cash and too much debt. I watched 2020 panic sellers miss the greatest recovery in history. Every crisis is different, but the mistakes are always the same. People think they know what's coming. They concentrate their bets. They use leverage. They have no cash buffer. They make emotional decisions in the moment, and they lose. Warren and I never made those mistakes, not because we were smarter, because we were more paranoid. We assumed we didn't know. We diversified. We avoided leverage. We kept cash. We had plans. And we survived every crash for 60 years. That's the only edge that matters. Survival. Let me make this simple. Here are the 5 rules. 1. Accept that you don't know what's coming. Position for multiple outcomes, not one prediction. 2. Reduce your concentration risk. Diversify across assets, geographies, and time horizons. 3. Cut your leverage now. Debt forces you to sell at the worst time. 4. Build a cash buffer, 6 to 12 months minimum. It's insurance, not investment. 5. Decide now what you'll do. Write down your plan. Follow it when the moment comes. These are not complicated rules, but almost nobody will follow them because they require giving up the illusion of control. I'm 99 years old. I won't be here for the next crash to tell you I warned you, so I'm telling you now. The portfolio manager who called 2008, he lost everything anyway because he tried to time it perfectly. The tech executive with $2.3 million, he's working 5 more years because he concentrated in one sector. The Chicago couple, they lost $80,000 because they used leverage they couldn't afford. The Seattle engineer, he sold at the bottom because he had no cash buffer. Don't be them. Open your brokerage account right now. Look at your portfolio. Ask yourself, am I positioned to survive a 40% crash without panicking? If the answer isn't a confident yes, you have work to do. And you need to do it today. Not tomorrow, not next week, today. Because when the next crash comes, and it will come, you won't be able to think clearly. You'll panic. You'll sell. You'll destroy years of compounding in a single emotional decision, unless you prepare now. The formula is right in front of you. Accept ignorance. Diversify ruthlessly. Cut all leverage. Build 6 months of cash. Write down your plan now. Follow those rules, and the next crash can't destroy you. Ignore them, and you'll join the casualties. Your choice. Now, if you want more brutal honesty about surviving markets, timeless principles that actually work instead of prediction garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth. And drop a comment right now telling me which of these 5 rules you're violating. Be honest, because you can't fix what you won't admit. The clock is ticking. Your next decision will either protect your wealth or destroy it. Choose wisely.